Welcome to Contributors Corner, where we break open the who, what, and where on what's affecting your investment portfolios. I'm Lindsay Malchuk, and back with me after his absence to rule the world of real estate, because let's be honest, he's not going to let me have all the fun, is the always ready to rumble Michael Succurro from Spark Financial. Hello, Michael. Great to have you back.
Thanks for having me back. I'm excited to be here. The market's shifting every which way nowadays, so it's an exciting time to have this discussion and talk about these exciting topics today.
Absolutely. The heat is on, and today we're not dancing around it. We're going straight for the jugular. Now, the Bank of Canada is what the topic is today, and they recently dropped their latest move. But was it guts or fear that drove the call? Cut or hold? It's not just about interest rates anymore. It's about pressure on households, on markets, on the system itself. Now, behind the headlines, we all know that mortgage pain is rising, defaults are creeping in, and investors are trying to read between the lines before the floor shifts again. So let's start there. Let's start at the core. Was this move confidence or caution? Pushback is rallying. What's the scene in your sector?
Yeah, so what we're seeing and what we speculated on with the rate hold was caution. And as much as we obviously want to see rate cuts, it's the industry I'm in as well. It drives buyer confidence. I think the hold was the right move in this scenario because again, if we look at the last 4 years, call it even 5 years now, we can't have short-term memory loss anymore. We have to understand what the mistakes were that were made to drive us to the point that we're at right now. And what happened was we had these drastic rate cuts, and it drove the purchase prices way above the limit that they should be today. And again, it's not the consumer's problem. That was also the government's problem for making those drastic cuts. And then also they've created the mess that we're in right now by raising the rates right back up. Because again, a lot of buyers, if you talk to them, they're like, yeah, the government said they're going to cut these rates and we're going to hold like this for 10 years. Meanwhile, in 2 years, we shot right back up above and beyond what people were definitely expecting. So the reason I feel, and many economists and many other people feel that the hold happened was, again, to protect those purchase prices. Because what is happening is that, or what will happen is that if you cut these rates, people will get excited again and they'll go back out there and start purchasing. Then you'll have bidding wars again and the buyer frenzy, and sellers are just going to be like, yeah, let's raise the price because it's a seller's market again. So that's why I feel the government held this time, the Bank of Canada held this time, was again to have that cool off period. Now, on the flip side, though, like you said, there's a lot of stress to a lot of mortgagees right now, as they're not going to be able to make these payments, not making these payments, and delinquency is on the rise because, again, March was the start date of all these renewals that were happening from, your 1.1 to 1.8% rates that were back in 2020 to now your 4 to even 5% renewal fees or renewal rate.
Okay, so let's push that a little bit further then. What does this do to the market? Where's the knee jerk and where's the deeper shock? This is now the second hold. Investors are definitely watching with some trepidation.
Yeah, what it does to the market is it just puts it at a standstill. It's you have sellers that want it to be a seller's market, you have buyers that want it to be a buyer's market, and it's definitely not balanced yet either. And it's a weird position we're in because again, sellers are holding firm on the sale price. Actually, let's put it this way: you have two different types of sellers right now. You have the ones that don't care; they want to sell, take advantage of the market. And why I'm saying they don't care is because they don't have a mortgage to pay. These are your baby boomers or anybody that's just smart with their money, that they don't have a mortgage to pay. So they're like, I want to sell for 2 million, whether it garnishes, a 2 million value or not. I don't care because I don't have to sell. But on the flip side, you have the clients that need to sell because they're being pressured because they can't afford the renewal or they can't afford the mortgage that they're in. And now they're bringing down the value of the market. So you have that standstill and that head clashing of the two different types of sellers. And on the flip side, you have the buyers that are like, I want a deal, I want a deal, I want a deal. So what's happening is, like I said, we're at a standstill. Because then you have investors that are on the way other side of things where they're saying, I'm holding on to my cash. I want the deal of the decade, if not the deal of the century right now. And that's why we feel that there's no movement right now. And the movement is only going to come from a forced play. And what I feel that first forced play is going to be is people having to literally walk away from their homes because they can't afford those payments anymore.
So what you're seeing actually too is there is always going to be a demand for rental properties. So let's just touch on that a little bit. How is this impacting the rental market? Is it a positive? Is it a negative? Tell me.
Again, it's becoming very, very area specific. And what I mean by that is, let's use the Ontario market. In in current subdivisions or even areas or pockets, what we're seeing on the real estate side is that the rent is staying strong because it's a desirable area. Whereas in these areas in Toronto, or let's say Northern Toronto and the GTA, as an example, they've built hundreds of condos, hundreds of thousands of condo units in the last 5 years that are now sitting vacant. So what's happening is that those condo units now are lowering their prices because no one could close on the mortgage. The builders are now being forced to make it a rental building. And again, you have that clash where people, they want to live in that more desirable area, but the rental market is not dropping. Whereas these areas where there's an influx of condo developments that are new pre-construction condos that have to start generating some type of income are now lowering the rental prices drastically. So again, you have that clash where it's yes, you have the news saying rental rates are dropping, rental rates are dropping. No, they're not. There's more rental units that are coming onto the market because those are simply just vacant buildings that the builders are trying to just generate some type of income right now, and they're dropping their pants on the price because they need to fill these slots, they need to fill these units.
Absolutely. I mean, here in Vancouver too, we're seeing that yes, people are saying, rent is lower than it usually is. Well, it's still so astronomical that that tiny little speckle isn't really making a difference to the wider range of people that are looking at that. Now, let's actually continue this just a little bit further and talk real world impact. You touched on the mortgage delinquencies and the defaults. Are we seeing like the system is starting to crack?
Yeah, absolutely. And then even just to go back on the rentals, that's why you're going to see a demand again on rentals because the system's starting to crack. And the conversation I'm having with many clients is like, I need to sell, protect whatever equity I can protect, and just go rent for a year, 2 years, and hope the market corrects itself or crashes or whatever they're hoping for. And then again, that's where it's like this slippery slope we always like to say is that they're they need to sell the property. They need to pull whatever equity they can pull out. And there's a demand for rent. But then again, you don't like the rent. Investors don't want to get into purchasing rental properties right now because the property value is still so high. The rates are so high that you're not breaking even on what you could charge out for rent. So you look at a condo, if a condo's at $800,000 and your mortgage is at $4,000 a month, you can't charge $4,000 a month on a 1+1 with a one bath. You're lucky if you get $2,500 if it's a really desirable area. So that's the whole standstill right now. It's like here's my comic book nerd in me, that whole Marvel meme where Spider-Man's pointing at each other's everybody's pointing at each other because they need to sell, they need to rent, the investors want to buy, they need a place to rent, but there's not a lot of rental options available because of the fact that nobody wants to buy rental properties because they're not generating enough ROI. It doesn't make sense for them to get into the rental market. Like I personally would not buy a rental property right now because I don't see it being feasible. You're not covering your costs.
So, if you were an investor watching this right now, Michael, what should you be locking your eyes on right now?
I think you should be looking at multifamily properties. So those are ones that are 4 units plus. And again, in maybe either distressed areas or even out of province. Like what's been hot right now and a hot topic is Alberta, because over there you could get a multi-unit residential property that has 10 to 18 units for $3 million, where that same multi-unit property in Toronto that goes for $3 million can maybe get you 4 units in there.
If that is that going to give you the ROI in Alberta that you're not going to get in Vancouver or Ontario?
Well, absolutely, because if you look at a $3 million property and let's just throw around the number there. Let's just say your mortgage is $20,000 a month. If you have 10 units to now rent out, you're at least able to get hopefully, let's say, 2 grand a unit. Whereas, so you're at least breaking even. Whereas in Toronto, that same $3 million is not stretching as far. Your money is not being stretched as far in Vancouver or Toronto. So that $3 million building now maybe has 4 units. Well, you can't rent each unit for $5,000. And that's where I'm going. And that goes back to what I was saying about investors are not seeing the potential in an ROI on these properties in these major urban areas because of the fact that you can't ask for $5,000. No one's going to come pay $5,000 for a condo or for a unit. If it's not, people are getting luxury homes right now for $5,000 to $10,000 a month in rental. So why would they go get your one bed, one bath unit? Whereas these outside markets like Alberta and Calgary, you could get that $3 million building that is a 2 bed, 2 bath, and you can rent it out for hopefully $1,700 $2,000 a month and actually break even on your investment or even potentially earn on your investment.
So what about fixed rates then? How does this move ripple through bond yields and borrowing costs for everyday Canadians?
Well, funny enough, the bond yield actually increased before the rate announcement last week, and we saw fixed rates come back up. And just to give you an example, I quoted a client on a 4.14% 5-year fixed rate. And thank God we did the pre-approval, because if we didn't, on the time of closing, it was actually at 4.34. So it actually went up 20 basis points. So we saw a little uptick. Now they've come back down a bit. So we've seen them pull back again 20 basis points. But again, a lot of people think the Bank of Canada correlates with the fixed rates. They don't. It's the 5-year bond yields that correlate with the fixed rates. And that is a beast in itself, because what we're seeing right now is actually with many lenders that the variable rate and the fixed rate are actually the same. And the question is, do you take the gamble of going variable, or do you go fixed? And again, it happens where I was talking with an older client the other day where he's like, I'm just going to go fixed because I've seen rates go to 12 to 18% in my day when they said they were going to hold and we were supposed to drop. So he's like, I'm not gambling with variable.
Right. Right. Okay, so sum this all up for us that we talked about today. We talked about a lot. What is the one piece of investment advice, in your opinion, that you would give at this moment with this newest BOC move?
Definitely don't run, walk, because that's what the Bank of Canada is doing right now. They're not running. They've learned from their mistakes because they massively messed up during COVID by cutting the rates as drastically as they did. And they massively messed up on their way out of COVID by increasing the rates as fast as they did. So think of that as for your investment. There's no great investments right now out there that you actually you absolutely have to run and not do any research on and be like, yes, I need this today. We're not in COVID times where there's bidding wars and you have to go firm. It's make sure you have your numbers right, know your numbers, know your math, cover yourself to make sure that this is the right investment. Because again, there's no deals that are flying off the shelves right now that you have to worry about missing out on.
Michael, always a straight shooter. Thanks for making sense of all the chaos.
My pleasure. Thank you again for having me on today.
To everyone watching, remember, rates may move in quarters, but markets move in seconds. So keep your eyes open, your strategy sharp, and we'll see you next time as Michael and I continue to unveil the evolving world of investment insights and sector education, all right here on Contributors Corner. Now, as always, these conversations are packed full of useful knowledge for your portfolio decisions, and remember, these are the opinions of our own with vested interests in particular assets and companies. Always be sure to speak with your financial advisor and know your own risk tolerances. For a copy of our full disclosure, head to the article below. Thank you again for joining us, and we'll see you next time.